Hey, what's up guys? Welcome back. So I haven't done one of these videos in a while, so I thought I'd do another watch this stock video. And I do want to bring the focus of this channel back to talk about individual stocks because I know you guys love hearing about analysis and hearing me talk about individual stocks, so we'll do exactly that today. And I gotta say, I do have a very interesting one to talk about today, and as the title of the video suggests, it is of course LMND, ticker symbol LMND. And today we're going to go through what the company does, obviously. We're going to run through some of the numbers and metrics surrounding this company. And lastly, I'm going to share some of my own opinions about this company and where I think is headed in the future. So this should be a very interesting video. And without further ado, let's jump in. Okay, so first of all, what is LMND? So LMND is an insurance service in the United States that seeks to make getting insurance simple and easy to understand, all through just an app on your phone. So what's interesting about LMND though versus traditional insurance companies is that LMND really tries to leverage technology in helping them determine the best prices and processing claims and whatnot. So there's no broker you can talk to. Instead, you talk to a chatbot and the company uses AI to determine what the best price is to charge you and how risky you are and stuff like that. So in particular, the company does do something called reinsurance to limit their risk, which is, if you don't know what that is, reinsurance is basically like insurance but for insurance companies. Basically, whenever you take out an insurance policy, they pay a second insurance company an amount of money to insure themselves sort of against you, right? So if too many people make a claim, then they have insurance policies on their back end to like back themselves up. So although they do have to give up part of their premiums that they collect from customers because they're using it to take on an insurance policy for themselves, they do like limit their risk on the downside. And also sometimes they can collect a referral fee for bringing business to that second insurance company. So rewind the video if this part is confusing. I know that the reinsurance part is kind of meta, right? So it's like insurance but on an insurance company. Anyways, LMND offers renters insurance starting at $5 a month, homeowners insurance starting at $25 a month, and pet health insurance starting at $10 a month. Of course, these are just rough guidelines. Of course, how much money you actually pay will have to depend on who you are and where you live and whatnot. But LMND claims to be able to offer the best prices due to their use of their algorithms, as I mentioned earlier, to optimize their premiums and such that in the case that you're not overpaying, but at the same time, they're not taking on too much risk either. So further, to give an extra incentive for people to switch to LMND, the company promises to donate part of their premiums to charity if they have money left over after a flat fee cut. So how this works is basically the company is saying that they're confident they're going to be able to generate a steady stream of income. So after they generate that steady stream of income, anything above that like certain profit line after they take their flat fee cut, they're going to be able to donate that to a charity of your choosing. So there's sort of like a social impact element to this as well, making the company very appealing to millennials because you guys know us millennials, right? We're all about that social impact. And to convince people that LMND is really serious about this charity thing, they're actually registered as a B corporation, which if you don't know what a B corporation is basically like this special certification that certifies that a company is doing some sort of like social impact or environmental good. And there's like this whole list of conditions that the company must meet to maintain that certification. So for example, another company that you might have heard of that follows the B Corporation certification is Patagonia. So they're known for kind of being environmentally friendly and whatnot. So yeah, that's what it is basically. And as to whether or not people are actually buying what the company is saying and enjoying the product and whatnot, if you look at the App Store and Google Play Store reviews, we do see that the company is very highly rated, and it does seem that people actually like the product and the service, which is a very good sign. However, let's take a deeper dive into the company's metrics and numbers, and for this we're going to look at the company's annual shareholder letter for Q2 2020. So at first, right off the bat, we can see that the company is posting some amazing growth. We can see that they've increased their customer base a whopping 84% year over year. Premium per customer was up 17% year over year. And if you multiply those numbers together, you get what's called the in-force premium, which is kind of like their total amount of premium that they're going to collect from customers. However, remember, not all of this is pure profit just because of that reinsurance thing I talked about earlier. So that $35.3 million number below is kind of like how much premium that they actually earned. So yeah, if you do the math, they're only making like 22, 23% out of that 155 million number that you see at the top. So anyways, you can see that it is up massively as well at over 100% year over year increase. So lastly, we see that their gross loss ratio has been decreasing, which is also very good. So if you don't know what the loss ratio is, it's like a thing that's specific to insurance companies, and it basically measures how much the company has to pay out in premiums and how much they collect in premiums. So for example, if a company pays out $80 in claims for every $160 of premiums that they collect, then the loss ratio will be 50%. And obviously you definitely don't want this ratio to be too high, and you definitely want it to be below 100%, because if it's above 100%, then that means you're actually paying out more in claims than what you're collecting in premiums, which is not good, right? So if you look at the data though, it looks like back in Q1 of 2018, that was exactly the case with Lemonade. So I'm glad that they were able to bring that number down. Now taking a slightly deeper dive though, let's look at the income statement. So once again, I'm not going to spend too much time talking about this because we just talked about some of these metrics already, but the main thing I want to make note here is that as far as you can see, for the past 3 months ended June 2020, Lemonade is currently not profitable as they lost $21 million, which doesn't sound that bad because I often talk about companies that are losing like much more than that every 3 months, but that is until you realize that they only brought in $29.9 million in revenue in those same 3 months. Now, I understand that Lemonade is still in the early stages of growth these days, and I understand that profitability is not the main concern right now, and the company has been improving their bottom line year over year, but the fact that Lemonade is still not profitable, this still does make them somewhat of a spec play in my opinion. Now moving on to the balance sheet though, we can see that the company still has plenty of cash coming in at $259 million of cash and cash equivalents. Now that is down slightly from December 2019, but that's completely normal as the company is still in the stages of high growth as I mentioned before. Now they do need to spend a lot of money to like grow the business, so that's completely normal. This isn't Berkshire Hathaway who just keeps a bunch of cash on hand, right? So looking at the liabilities though, I do want to make a note on this unearned premium section, which, you know, for long-time viewers of this channel, you would remember me talking about cruise lines before, where cruise lines, they have this like cash deposits line under liabilities, and basically what it is though is that when customers reserve a spot on cruise lines, back when people actually had to, you know, fight for cruise line tickets, you might have to put down a deposit to reserve the ticket, right? So you put down a cash deposit to hold the spot, and from the company's perspective, even though that is money that they have on hand, it's technically like not their money in case you decide to cancel, and they might have to return the deposit, right? So it's technically considered a liability because it's technically not their money, and they haven't earned it yet. So this unearned premium is kind of like the same thing, right? So since with Lemonade insurance policies, you can cancel at any time. So if a customer pays in advance but then decides to cancel, well then you might have to give back some of that premium that the customer paid already since they haven't used it, right? So therefore as a company for Lemonade, you do have to like kind of put that under liabilities even though that is money that you already have. You haven't earned it, just like the cruise line cash deposits. But if you think about it, this is like a different liability than like money that you owe, right? So this is different than if, let's say, you hired a contractor to help you build the app and then now you owe them money, right? So this is still technically though from an accounting perspective a liability. So you still do have to put the unearned premiums under liabilities section, but in short, it's just like an accounting thing, and it does make the balance sheet look a little worse than it actually is. So if we take out the unearned premium section, we can see that Lemonade actually doesn't have that many liabilities. So in conclusion, I do think that the balance sheet is pretty good, and I don't have any major concerns surrounding the balance sheet. So I'll leave the numbers analysis here, and now let me talk about a bit of my own personal opinions about this stock. So obviously I do like the stock a lot, and I do like the idea very much, and I do like how the company has a social impact element to it as well. I do think that the insurance space could use a lot of disruption actually, because in my own personal experience, I just feel like that the insurance industry as a whole is very outdated and broken, right? So traditionally, if you wanted to buy insurance, then you have to call up your broker, and then you have to like shop around and find the best deal. And it's not a fluid experience in my own personal experience, at least. So I do think that there's a lot of growth that can come out of this space. In fact, a large part of the success of the famous investor Warren Buffett came when he entered into the insurance game. So according to the man himself, Warren Buffett told shareholders in a 2004 Berkshire meeting that if Berkshire hasn't acquired National Indemnity, which is one of the first insurance companies that he bought, Berkshire will be lucky to be worth half of what it is today. So he said this in 2004, by the way. So this was quite a long time ago. And specifically with regards to Lemonade, I think it's only a matter of time before they go into the like other type of insurance businesses, right? I'm talking about like car insurance, life insurance. So it's only a matter of time before they enter into new markets. And I've also seen a couple of interviews with the CEO of Lemonade, Mr. Daniel Schreiber, who claims that Lemonade is able to collect 100 times more data than a typical insurance company because of Lemonade's AI technology. And maybe it's because I'm not a computer scientist, but that does seem like kind of a pretty bold claim. But right now, I'm not completely convinced of that just yet, but we'll see how it goes, right? And while looking at the stock, we can see that the market definitely seems kind of convinced, because despite a recent pullback, the company is still trading at some sky-high valuations. So looking at the price to sales ratio and the EV to revenue ratios, they're both over 30, which if you know anything about those ratios, those are incredibly high valuations. So in conclusion, am I buying Lemonade stock though? Well, I definitely have to say I'm tempted to do so, right? But I'm finding a hard time pulling the trigger just because of the valuation. And for that reason, I think I'll hold off buying the stock for now. And I do think that Lemonade is sort of too speculative for me at the moment to be buying this stock right now. And I already have a lot of speculative bets, so I'm not really looking to add any more. I'm actually looking to add more like solid blue chip companies. So yeah, right now I haven't bought any Lemonade just yet. And also I do want to wait a while to see if things really do work out well for them. I hope it does. You know, I wouldn't mind buying into the stock once they post like some more solid numbers and have like a longer history of success, right? So even if that means I'm losing out some potential gains, I think that just because of my reduced risk of investing in the company after they've achieved like a stable business model, I think that that will be worth it for me. So yeah, right now it's a little like too speculative for me, but I'm definitely gonna watch this stock very closely. But anyways, let me know what you think of Lemonade though. Be sure to leave a comment down below letting me know what you think. And yeah, I'll leave the video here for today. Be sure to hit the like button if you enjoyed the video, and consider subscribing if you like this series. Be sure to follow me on Twitter and Instagram, links down below in the description as always. And with that being said, I'll see you guys in the next video. Bye bye.